Those are the rapid fire questions?
Yeah.
Oh my god.
That's it.
Oh my god.
Thanks for doing this. This was so fun.
Oh my god. My cheeks are like... I was like...
It's nice to put a market maker in a tough spot for a change, right? Because it's always you guys are ones that are like controlling the markets and putting us in a tough spot.
No, we're not. No,
yeah.
but...
market makers are very important for a healthy and efficient market.
Yes. Yeah, but being completely honest, like when I speak, sometimes in like conferences, I'm like, oh yeah, we're a market maker. Yeah. Oh, which marketing agency? And I'm like, no, it's market maker. Yeah.
Here comes the money.
Here we go. Money talk.
Here comes the money. Money.
Let's try to understand market making now, right? Because I feel like this is a topic which is always, it's always like so sensitive or discreet to talk about. So it's like very difficult to find a lot of information about it, because of which there's a lot of misconceptions about this as well in the public domain, right?
Yeah,
especially like first-time founders, they don't understand how this works. And it could really like make or break their tokens, right? Can you explain us what market making is, who are market makers, and explain it to us like we're 5?
Okay, no worries, that's great. Look, as what you're saying is true. It's not a topic that's so talked about, and you can find so much information, like for, you know, if you're talking about GameFi projects, you can find many different sources. Right. And it's not just in crypto, right? Market makers also exist in traditional finance.
Right.
But when we're talking about different assets, and in this case we're talking about crypto, right? Cryptocurrencies, you can buy or sell the token, right? The thing is, in order for you to buy or for you to sell, there's always a counterparty. Mm-hmm. So if I'm buying, there's someone on the other side that is selling the token. And the same way, the other way around, right? What happens is market makers, they are this, let's say, some invisible agents mm-hmm. that are behind, you know, different types of tokens, and they are there to provide liquidity, which means market makers are on both sides of the end. So we are at the same time buying and selling tokens in order for other agents from the market, for example, investors or normal retailers, to buy and sell the tokens whenever they want. So market makers are working 24/7 because the market is 24/7 open, and they are at all times buying and selling in order to people to buy or sell their tokens. Yeah. Just to, you know, wrap up, market makers are supposed to be liquidity providers, and the same time, and most of the time when you're selling or buying a token, it's not another person that it's selling or buying off of you. A lot of the times, or majority of the times, it's going to be a market maker. Right. This specific market engine, let's say so, that it's helping to make a token more liquid, more traded. Whenever you're looking into a token, right, or any other asset, you don't want to buy something that has a huge spread, or something that it's going to be really difficult for you to sell, mm-hmm. right? A liquid asset. So the main job of a market maker is to tighten the spread, provide liquidity, make the token as, how can I say, the trading experience as enjoyable as possible, mm-hmm. let's say so.
It's enjoyable only when you make money.
No. Okay, but try to make the market as healthy as possible, right. in order to, you know, whoever wants to buy or sell, right. can execute as seamless as possible. Regarding spreads, right? There's like a mid price, and then there is the lowest price that the asset is being sold, buying off, and then there's the highest price that the asset is being sold. So the
ask price.
Yeah, ask and bid. Yeah, exactly. So there's going to be this difference of price, so the lowest point and the highest point, in which we see the spread right here in between this middle. I don't know how to. It would be better if we had like something to write. But anyway, so the spread would be this difference of the lowest and the highest price that the token is being traded, token or any other asset is being traded.
Right.
How market makers make money is that, again, recapping, we're buying and selling tokens at all times, doing the strategies. So we make money out of the spread. Mm-hmm. Of course, we're buying the tokens at the lowest point, mm-hmm. and then we're trying to sell at the highest point. So that's the difference.
That's exactly what I'm trying to do as a retail investor.
Yeah, exactly. No, but that's how we're making money.
Yeah.
During the day, right?
Right.
Because the strategies, they work per second, per millisecond. But of course, it's not like infinite amount of money. You don't make like a huge, let's say, profit out of
Mhm.
one trade or two trades, because at the end of the day, you're trying to make the spread as tight as possible so people can trade and have the seamless experience. So the spread, it's not like, if it's not a good market, it's not going to be like huge price differences. It's going to be as tight as possible, so you need to make millions and millions of trades in order
Right.
for you to make to profit, or
Right.
make your money. Yeah, several market makers are in the space. There's several models to work with, from a loan model to a monthly retainer model, so you need to see what works best for you.
Can you explain these models?
Yeah, sure. So I'm going to explain the loan model first. So different market makers have different strategies. Of course, on the trading side, especially because everyone has their own like proprietary trading strategies. But when it comes to how you can engage with market makers, the two main models you will see is the loan model and the monthly retainer model. Loan model, which is the one used by majority of market makers, I believe, especially like the bigger ones, and it's our case as well. The token issuer, which is the project, they will lend us a certain amount of tokens. The amount will depend, of course, which exchanges you're going to get listed on, what's your tokenomics like, how many tokens you hold, etc. Because all exchanges have some sort of liquidity requirements. So, for example, if we're listing on a bunch of exchanges, especially Binance, each one will have certain liquidity requirements that we need to meet. But anyway, so the project lends us a certain amount of tokens. Each market maker calculates their own way. But then after the project lends to us, we agree on certain strike prices. Could be.
What's the strike price?
Okay, strike price. So depends on what type of call option you're using, because there's like American style, European style, Asian. There's even like a Bermuda call option, whatever. Anyway, it means that once a certain price is hit, us as a market maker, we have the market maker or whatever, you have the right to execute this option. So for example, I have token 1, and let's say, so we agreed that once the token X reaches 150, we have the right to buy off this position at this price or not. We have the right. It doesn't mean that we will. So that's pretty much it of the idea. So market makers that work on a loan model, they will agree on certain call options. If it's going to be American style, European style, depends on how the market maker works. But then, yeah, at the end of the agreement, once the agreement has expired, the market maker has the right to return in USDT or USDC or whatever other currency that they've decided, if they have executed the call options or not. Or they can just return the full amount in tokens. So, you give to me 100 tokens, I'll give back to you 100 tokens, or I will buy the certain amount, the whole amount in USDT, and I'll just return to you the money. Or I can do a mix of both. Like I executed 2 call options out of the 5. I'll send you the USDT. It means that I'm buying off this position at this price. And I'll just return the rest to you in token, because we may have executed those call options, like we have reached those prices, but we didn't want to execute the call option, or it ended up not hitting those prices that we were expecting. So we don't have the right to execute those call options anyway. So we need to return to you.
Got it.
Yeah. So that would be the main idea. And then in our case, we don't request any USDT or any other anything else from the project issuer. We just need the token in order to provide liquidity on the exchanges. But the USDT, etc., it's all from us. And then each market maker, of course, some have like setup fees, someone has this or this. It depends on who you're working with. And then the monthly retainer is a little bit different. So they will not require from the project tokens. They will require a monthly payment. Depends on exchanges, the pairs. but they are going to provide liquidity with this payment that you do every month. But in terms of how long the agreements are, or if it's executed on a monthly basis, I have no clue because I never worked on a monthly retainer basis, so I don't know.
Okay.
But usually with loan agreements, it could be 6, 12, 24 months or even longer. Depends on how the deal is structured.
So mostly loan agreements is the model that's being used?
Yeah, it's the model that's used by the biggest market makers right now. And yeah, I think it's the preferred way for a lot of the projects to work with like a loan model. Because, for example, if you're a smaller project, paying a couple $1,000s per month for a service could be quite costly as well. So it could be more interesting to work on a loan model, for example. But on the other hand, a token issuer, they don't have much tokens in their hand. They would prefer to work on a monthly retainer basis. Great, there's also this option. So that's why I say there is not like a perfect model for all projects out there, because there are thousands and thousands of projects. And at the end of the day, like DWF is integrated with XYZ exchange, but there are certain exchanges that we're not integrated with, and then maybe another market maker is. So it could be interesting for projects to work also with more than one market maker. That's what we see a lot, especially with like higher market cap tokens. They usually work with more than one because they're looking to differentiate their strategies, and sometimes the market maker is not integrated with one exchange that they're listed on, or a market maker, is non-operating in US, for example. There are different ways that token issuers can work with market makers, and I don't think there's just one-stop solution, and you just need to find the right partner. At the end of the day, like any other business relationship that you enter, you need to check if there's a culture fit, if you have seen their previous works, you've enjoyed what they've done for other tokens, and you see which one would make more sense for you.